Hey guys, this is Derek, CPA at GreenGrowth CPAs. We're really excited that you're watching our webinar. If you have any questions with the webinar, please feel free to reach out to us, greengrowthcpas.com, or you could give us a call. Welcome everyone. Really excited for the webinar. I see we have people from all over the US, which is insanely exciting. Hello Tamsin, you are tuning in from Humboldt, Southern Humboldt. Looks like Kaylin, you are with Green Rush Alliances, really exciting. Let's see, Jennifer, hello from Alaska. Wave all the way over there. I'm glad you guys have internet, and I think you guys still have one last blockbuster left. Super jealous about that one. Hey Tyler from Denver, Colorado. Really good to have you here. Teresa from Oregon, welcome. Claudia from Oakland, hello there. What's up, David from Nevada County? Hey, Allison from Santa Rosa. Wow, this is great. Holly from Pacifica. Hey, Holly. Hey, Jeff from Newport. I actually grew up in Newport Beach as well. Graduated from Newport Harbor High School back in the early 2000s. Mark, Huntington. I love surfing in Huntington. Great waves. Let's see. Tanura, welcome from DC, the nation's capital. Drew, what's up from LA? If you're ever in the Mid-Wilshire area, stop by our headquarters. We are right next to the Grove. San Diego grad. Ooh, Boo Newport. Oh, come on. You guys are the Sea Queens, no? Let's see, Dave from San Diego. What's up, Dave? I actually just moved back from San Diego. We were in University Heights, which is such an awesome part of town. Let's see, Deb. Hey, Deb. Jude from Mendocino, welcome. So guys, we're really excited to present our topic today, which is taxes and 280E. What are your responsibilities? Just as a quick disclosure, the information contained in this PowerPoint is meant for guidance purposes only and is not professional, legal, or tax advice. Remember, we are a CPA firm and we unfortunately cannot give legal advice. We can only talk to the tax issues. Further, we unfortunately cannot give personalized legal tax investment or any business advice in general during this PowerPoint presentation. We can simply talk about the issues themselves. Let's jump into it. The topic for today's discussion will be taxes and 280E. What are your responsibilities? So a little bit about our agenda today. We'll go over who we are as a CPA firm. We are called GreenGrowth CPAs, and we are a full-service CPA firm servicing the cannabis industry. We'll briefly talk about business structuring 101, which will include nonprofit mutual benefit corps, as well as cannabis tax responsibilities. We will cover 280E and cost of goods sold. We will then chat about what deductions you can and cannot claim. And then we'll briefly talk about penalties and benefits, as well as bookkeeping best practices. So with that, let's get started. We are GreenGrowth CPAs. I personally am Derek Davis. I'm a CPA at the firm. I've personally been licensed since 2012 as a CPA, licensed in the beautiful state of California. I have almost about a decade of corporate taxation experience, and I started my tax career at Deloitte Tax as well as PricewaterhouseCoopers. In 2015, I was fortunate enough to testify on Capitol Hill regarding tax policy reform, and I've been quoted in several tax policy and tax referendums, as well as my personal involvement in cannabis starting in 2010. When it was previously on the ballot to be fully legalized in the state of California, and that's also when 280E came out. As many of you know, unfortunately, cannabis was not passed in 2010, but we did finally pass full-scale recreational licensing in 2016. So let's talk about business structuring. We'll briefly talk about nonprofits or cooperatives, as they are usually known. Some pros of these structures is that they may be subject to lower tax benefits, but one thing that's really important to remember is that even if you are a nonprofit, you will generally not be allowed nonprofit tax exemption. So a lot of clients will come to us and say, hey, we're a nonprofit, therefore we don't have to pay tax. Unfortunately, that has never been the case with cannabis operators. If you are a cannabis operator, we have never seen a case where they have been granted not-for-profit status. So it's really important to remember that even if you are legally incorporated as a nonprofit, you will still have to pay taxes as a for-profit company. One of the biggest cons of being a nonprofit is that you cannot take a distribution, and you also cannot buy and sell your nonprofit entity, which also includes a ton of additional paperwork that goes along with being a nonprofit. So one of the drawbacks of that is that if you are a nonprofit and let's say you build up a huge brand name and you have a great brand and you have, tens of thousands of customers that love your product, being a nonprofit will not allow you to sell your company. So you can't cash out at the end of the day because technically under the nonprofit rules, you don't own the company. Another type of business structure that a lot of companies look at is B Corps. Really, the only really good tool that we've seen for B Corps is that they're a great tool for marketing. So a lot of people like to see B Corps as, being more economically resilient, and sometimes it is more attractive to potential investors as well as hiring and retaining top talent. The obvious cons of a B Corp, of course, though, is that it's really hard process to go through and to get B Corp certified. They also face higher levels of scrutiny, both internally and externally, and shareholders generally tend to have more power than a normal C Corp or S Corp. In determining, if a B Corp is right for you, you really want to determine if that additional certification will really move the needle in terms of your sales. If you really believe that you can increase sales by being a B Corp, then that may be of interest to you, but otherwise, it's just a lot more paperwork and it's a lot more restrictive. C Corps and S Corps are obviously the two most common business structures that we see. The pros of a C Corp is that it reduces the potential liability of the individual owners. The cons of a C Corp, of course, is that there's double taxation and there's higher federal and state filing fees. Generally in the cannabis industry, you generally see a retail-based operator being a C Corp, specifically because if they ever were to be audited by the IRS and the IRS disallowed a lot of their expenses and said that these are non-deductible under 280E, that the liability may become so big on the owner that the company goes out of business. And if you're a C Corp, generally speaking, you will have that tax liability absorbed by the C Corp itself and it won't be passed on to the individual owners. But again, for these specific legal requirements, we suggest that you talk to a lawyer as we are not a law firm and we cannot give legal advice. We can only speak to the tax implications. S Corps are generally good companies for product producing companies. So, whether you make your pre-rolls, you are a cultivator, you are a manufacturer, anytime you produce a tangible product, S Corps usually make sense because of the main pro that it is not subject to double taxation. So you as an owner of the S Corp and as of the company, all the profits and losses will flow through to you individually. There's also some personal liability protection, which is also great to have. The real big con of an S Corp is that there's rules and fees that apply, and you're required to pay yourself a reasonable salary. So let's say at the end of the year, you net $100,000. Generally speaking, you want to pay yourself at least a 60 to 70% salary. So $60,000 to $70,000 will be a W-2 wage, and the remaining amount will be taken as a distribution, which will not be subject to self-employment tax. And those are really the benefits of S Corps. And luckily, we can model out what the two different scenarios will look like, whether it be S Corp or C Corp, and what your potential taxes would look like. And then we can also talk about what a potential tax liability would look like if you were in the event of an IRS audit and there's a huge adjustments with penalties and interest. Sole proprietorship is another form of an entity, which is really no entity at all. And a sole proprietor just means that an individual's like, hey, I'm going to start my own, let's say pre-roll brand, and I'm going to go out into the marketplace and I'm not going to set up any legal entity. The pros of that is that it's really simple because you may have to file, some respective filings based on how you're operating, but beyond that, all of the profits and losses will flow to your Schedule C. The main con, of course, of a sole proprietorship is there's a huge level of personal liability. So if you were ever potentially sued, they could just go after you personally, and they could potentially take away your house if you own one, your car, any and all assets that you do own. If you were to be sued, they would just come after you individually. The next type of business structuring is a general or limited partnership, an LP. There are a lot of tax benefits for partners of an LP. Generally, a limited partner and a limited partnership can have very favorable tax benefits, and they may not be subject to self-employment tax, so they can just take a distribution. So there's definite advantages for limited partners. The cons are that there's compliance challenges and the risks may be passed on to the general partners. So in any limited or general partnership, you always need to make sure to have one general partner, and that general partner can also be personally liable for the debts of the company. So if you're a general partner and you get sued, they could potentially go after your personal assets. So depending on who you're working with and what your team structure looks like, will generally dictate the terms of that arrangement. And last but not least, let's talk about LLCs and LLPs. I'm starting to see a lot of questions coming in the chat box, and we'll try to answer all the questions at the end of our webinar. But of course, if we're unable to get to them, please reach out to us, greengrowthcpas.com. Our phone number will also be listed at the end of the slide deck. So please don't be a stranger and please reach out to us. LLCs are probably one of my most favorable entities from a tax perspective, simply because it allows for flexible management structure. You do have some limited personal liability, and you have various different tax options available to you. So for example, you can be an LLC and taxed as an S Corp or C Corp. Or you could just be taxed as a general partnership. So there's a lot of different ways to be taxed, and an LLC will give you that flexibility. The only cons, of course, is that there may be special taxes levied at the state level, and there's also less structure, and investors aren't as comfortable with LLCs as they generally are C Corps. Generally, an investor will like to have special terms and preferences, and those can oftentimes be more easily laid out in a C Corp. Let's say on the event of a dissolution, the investor may get paid out first, or they may have first rights to the assets. So there's various different structures that a C Corp can provide that a LLC may not. But of course, you can always amend the operating agreement. So if an investor wants specific preferences, you can put that in the operating agreement to provide that to them. But overall, I think LLCs are generally a safe choice. So we're going to briefly talk about mutual benefit nonprofit corporations. These were prevalent in California pre this year. And so we still see a lot of these entities sitting around. So we want to talk about the structure and the assets associated with these corporations. But more oftentimes than not, and especially going into 2019, you want to dissolve your nonprofit mutual benefit corporation and turn it into a for-profit entity, as we previously discussed earlier in the slides. Some defining characteristics, of course, of nonprofit mutual benefit corps is that the assets of the corporation can only be distributed to the members upon dissolution of the corporation, not during operations. So what that means is that if you are set up as a nonprofit mutual benefit corp and you're one of the partners of the company, or you're one of the potential directors and you want to exit the company, you unfortunately can't get your assets. Let's say you have a large CO2 extraction machine, you cannot get that asset until the corporation dissolves. So, when thinking about structuring and dissolution, more oftentimes than not, nonprofit mutual benefit corps are not the go-to entity. So as a cannabis operator, you may be responsible for 4 different levels of taxes. So you'll obviously have your sales tax, you'll have your federal and state income tax, you'll have your state corporation filing fees, and then you'll have your normal cannabis taxes that are generally assessed at the local level. The best thing to do more oftentimes than not, if you do have a nonprofit mutual benefit corporation, is generally to dissolve the corporation and not convert it. But of course, if you're looking at both options, you want to read through your articles of incorporation. Oftentimes, a more sophisticated attorney will set up a C Corp and they'll have a nonprofit section. And generally, our attorneys that we work with have recommended that structure because if you wanted to convert, all you'd have to do is axe that section out of your articles of incorporation. But again, check with your attorney as that is more legal based and we can only speak to the tax, finance, and money related issues. Some other things you may want to look at is the depreciation of fixed assets. Sometimes, if you depreciate your CO2 extraction machine, you'll get a great tax benefit. But upon dissolution, if you have to sell it, there may be a gain that you sell it for and you'll have to pay taxes at that gain. Some other things you may also look at is the basis of the property. So, if you're specifically looking at whether to dissolve or convert, definitely check with your lawyer as well as check with your tax advisor to make sure that you won't be subject to a ton of taxes upon dissolution. Okay guys, so now we're going to talk about taxes and 280E. So as you can see in the side-by-side comparison, you have an ordinary business and a cannabis business. They both make $1 million in sales, and they both have $400,000 in cost of goods sold. They both also have $500,000 in sales and marketing expenses, but the ordinary business can deduct that, and the cannabis business cannot deduct that. So what you can see is that, and this is simply at the federal level, it also flows down to the state level as well, but the ordinary business only pays $35,000 in taxes, while the cannabis business has to pay over $210,000 in taxes. So the discrepancy between the two is huge. And without proper tax planning and tax structuring, you may find yourself on the wrong side of the fence come tax season time. So it's really important to understand what 280E and how do you work with it. 280E is pretty much a federal regulation that forbids your sales and marketing expenses. It is there because of the Reagan era Just Say No campaign that allowed drug dealers to sell their cost of goods sold, but did not allow them to sell their sales and marketing expenses. And this is unfortunately because cannabis is still a Schedule I drug. For 280E to go away, it would have to go from Schedule I to Schedule III. So let's talk about potential sales and marketing expenses. Any amounts that you pay to Weed Maps is non-deductible. Any amounts you pay to Leafly or any other marketing platform is non-deductible. Any type of sales brochures, sales catalogs, product catalogs, those are all generally not deductible, as well as the head count. If you have a sales team, those expenses are non-deductible. So it's really important to understand how 280E negatively affects your business, and it's really important to understand how to structure it correctly. So when it comes time for April 15th, you don't have this massive tax liability. This is unfortunately the case, from our perspective for the foreseeable future. So, unless, in the midterm elections, Congress flips and they decide to deschedule cannabis, it's probably here to stay for the next couple of years. Another thing to be mindful of is that when thinking about either starting your company or operating your company, you want to see how each city will tax their cannabis operators. So for example, if you're thinking about going into the city of Los Angeles, it's important to remember that there's a 5%, generally a 5% top line tax that's levied for the operators. Whereas if you go to Oakland, there's a 5% tax on medical, but there's a 10% tax on recreational. So taxes become a really important issue because they can really muddy up your cash flow. And if you want to charge out the taxes that the city charges to you, you're obviously more than free to do so, but then you're going to have to pass that cost on your consumer. And so, if you decide that you're a cultivator and, your price per pound is $1,200, but then you charge out all the cultivation taxes, all of the city taxes to the respective customer, your price is going to go from, $1,200 to, let's say, $1,700. And that may just price you out of the market. So it's really important when you're thinking about running your business and starting it, how the local taxes will affect you. Oftentimes, you'll generally see about 3 different types of taxes. You'll see a tax on the square footage. You'll see a tax based on sales, and oftentimes that'll be an absolute dollar amount. And then you'll oftentimes see a tax on a percentage of sales. So, it's really important to evaluate, how much is real estate, how much are taxes, and how long it'll take to get started, because these 3 factors they'll generally dictate in the long term whether your company will win or potentially lose. So for example, sometimes, you can go out in the desert and there'll be cheaper access to real estate, but then the taxes that are levied on you are so high that you might not even turn a profit. Whereas, if you go in the city, the real estate may be more expensive, but the taxes are lower, and so you may be more competitive. So it's really important to understand how the taxes are being levied at the local level to determine if you will make a profit in the long term or you'll make a loss. In addition to all of these taxes, you have to still be mindful of the sales and use tax. So this is sales and use tax for everything. So, generally you go to any sort of store, you buy any sort of product, they'll generally have a sales and use tax. And so the sales and use tax is an additional tax, and it's different from the local cannabis taxes. It's another layer of tax. So, at times it's a little bit, disheartening that taxes are being levied on taxes, but it's really important to make sure that your company's structured correctly so you don't get slaughtered in all these taxes. And of course, sales and use tax is generally based on your top line revenue. So say, for example, you sell $100 worth of product and your local city tax is 9%, and then your local cannabis tax is 5%. So you're effectively paying 14%, which is a huge percentage amount of all your income to taxes, whether it be to the local cannabis tax or the sales and use tax. Cost of goods sold is pretty much your best friend across the board in terms of saving money from taxes. What you generally can deduct is your product packaging and anything directly related to the sale of the cannabis product. The invoice for cannabis is generally less any trade and other discounts that you provide. So those are other deductions that you can take against your net sales. Electricity bills are obviously really great if you're a cultivator and you have a high electricity bill, high water bill. Those are things that can absolutely be deducted against your cost of goods sold. Some other things that you may also want to think about is your transportation costs. Picking up the product can be considered, if you're a distributor, a cost of goods sold, but then distributing the product to the end retailer, the end delivery, is generally a cost of sales and cannot be deducted. Some things you generally cannot deduct or you need to be very clear on is payroll, office supplies, and anything that does not directly relate to the cost of the product. So at the end of the year or towards the end of the year, when you're thinking about tax planning and you're trying to figure out how much tax you owe, make sure that you go line item by line item down all your expenses and determine whether you believe it's related to cost of product or cost of sales. And if you're confused, obviously reach out to your tax advisor, reach out to us. We'd be happy to help go through all your line items and determine what we reasonably think can be applied to cost of goods sold or what we reasonably think should be a selling expense. Unfortunately, we always have to talk about penalties because they're a huge aspect of the space. Unfortunately, if you are a licensed operator, we're seeing out of Colorado that are actually around 21% of operators are being licensed. There's a lot of rumors in the space that it's, based on this new administration, which we obviously can't independently verify. But what we're seeing is that as licensed operators, they're really easy to get picked off and to be audited. For those of you that are super geeks on taxes, such as myself, check out the Alterman tax case. This was a recent tax court ruling for a dispensary, and unfortunately they went back to their 2013 tax period. I think the biggest takeaway from that tax court ruling is that they had no documentation or very little documentation to support their cost of goods sold expenses. And so what happened as a result of that is that the IRS came and said, okay, you have no documentation on your expenses. We're going to disallow all of your expenses that you took on your tax return. And we're going to assess a huge penalty plus interest plus the adjustment itself. And I believe it pushed them out of close or to out of business. And what we found is at least 90% of cannabis companies aren't doing the cost accounting throughout the year, and they're not properly documenting as well as keeping track of all the records that they need to make sure that in the unlikely event of a tax audit that they can have all the supporting documentation that they need. Okay, so now we will chat about cost of goods sold best practices. One of the best practices is to create separate account ledgers for cost of goods sold expenses as well as your regular business expenses. You really want to break out your expenses into two categories: things that you can reasonably deduct as cost of goods sold and other business expenses that you don't believe would qualify under cost of goods sold. And it's really important to reconcile the two and determine, can you reasonably allocate this to cost of goods sold, or is this really a sales and marketing expense? The next thing you want to do is you want to set up a system of checks and balances to verifying your cash flow and making sure that reconciles to your point of sale system. Oftentimes, because it is a cash-based system, we'll see that there's a lot of points of failure along the way where cash can be siphoned off. Maybe intentionally, maybe not intentionally, but because we operate in a strictly cash-only environment, there are many points along the way where cash can be potentially stolen. So it's really important that you set up independent checks to making sure that all the cash reconciles to your point of sale system. The next thing you want to think about setting up is a strong inventory management and record keeping system. It's always great to have backup records and documentation for all your expenses in the cloud or off-site that's not just paper. What we find with a lot of our clients is that the paper trail and keeping all your receipts and keeping all the paperwork will get lost. And so when it comes to getting audited, you can't find any of your paperwork. So it's always important to keep digital copies and digital backups of everything. The next thing is you want to obviously set up controls to prevent fraud and theft, whether that be the cash or the product itself, and making sure you have clear reporting and clear reports on who handles what, and making sure that if you have an inventory manager, that they own the inventory and people are independently auditing their work. The last thing you want to do is make sure you reconcile your general ledger with the different accounts either on a daily, weekly, or monthly basis. I would generally say a bi-weekly basis, depending on the volume of your transactions, is usually the best. But if you're doing less than, let's say, $250,000 a month, then maybe you can do that weekly or monthly. The last thing you want to do is you want to make sure to keep a strong paper trail with receipts signed by the vendors as well as the pay slips signed by the employees. This is really, really important when it comes down to the resale certificates. So let's say you are a manufacturer, for example, and you don't provide timely resale certificates. If you were to undergo a sales and use tax audit, they could come in and say, hey, we don't know if you sold these products to a dispensary or you sold it to the end consumer. And because there was not a timely resale certificate provided, that you're going to be subject for the sales and use tax even though you provided it to the end retailer. And what they'll then do is they'll say, okay, now you owe 9% sales and use tax plus penalties plus interest, and assess a huge amount. So it's really important that you have backup and you have a really strong paper trail, generally in a cloud environment, to make sure that 5 years down the road, if you do get audited, you can easily pull all your back files. So some key takeaways is that nonprofits, regardless of if it's a California cooperative or nonprofit mutual benefit, is that you still have to owe tax. Tax code 280E generally only means you can deduct your cost of goods sold, and your cost of goods sold is limited to certain specific business expenses. Unfortunately, if you're a licensed operator, you may likely be subject to an audit, so make sure you keep really strong records and you also keep digital backups of all your filed. And when in doubt, consult with a cannabis-specific expert. Oftentimes cannabis operators, and I've heard this time and time again, where cannabis consultants charge more money, but in the long term, they'll save you the headaches that a non-cannabis operator just doesn't have the industry insight. So I do see that we have a bunch of questions coming in, but I do see that we've also ran over our time. So if you have any follow-up questions, please reach out to us, greengrowthcpas.com. Feel free to give us a call. We are here to help. And I hope you enjoyed the webinar. If you have any future recommendations or suggestions, always reach out to us. We're here to help. Thanks all.